The stock market can somehow see the future. At 11:38 a.m. on January 28th, 1986,
2, 1, and liftoff.
the Challenger space shuttle launched, and 2 minutes later, it took more than 5 months to conclude that the cause of this explosion was the space shuttle's O-ring in the right solid fuel booster rocket, which was attributed to a company called Morton Thiokol. This was one of 4 of NASA's contractors. About 20 minutes after the explosion, all 4 of the contractors for NASA's stocks went down, as expected. But Morton Thiokol was hit the hardest. On that day, nobody knew who to blame for that explosion, but somehow the markets knew. It's an interesting case of the wisdom of the crowds and how markets can reflect information that wasn't entirely obvious to us at the moment. Financial markets are informationally efficient, meaning that asset prices fully reflect all the available information at any given time. It was developed in the 1960s by economists named Eugene Fama. One implication of this is that it's impossible to achieve higher than average returns through stock picking or market timing because any new information that could impact an asset's price is incorporated into its value instantly. Breaking news of your company's stock, the market already knew this before you, and it's priced into the stock. A major war broke out impacting macroeconomic conditions. Bankers knew this 3 weeks ago, and it's all priced in. Jerome Powell and Janet Yellen started OnlyFans to offset the national debt. Priced in and subscribed. God bless America. Criticisms. Despite its widespread acceptance, the efficient market hypothesis has been criticized on many grounds. Critics argue there are many instances where markets don't behave efficiently, as we see instances of financial bubbles, market crashes, and instances where prices deviate significantly from their intrinsic value. These are rational moments where markets behave erratically and inefficiently. Scholars often term this not wisdom of the crowds, but madness of the mobs. Many behavioral economists disagree with the efficient market hypothesis. They argue that markets are not really driven by the rational use of information. Rather, they're driven by fear and greed. This is not a suggestion to be very active with your investments. Rather, it's a warning not to be overly passive. You need to be versatile, like the guys on that famous trading app, Grindr.